This episode is brought to you by Marqeta. Payment programs that scale and customer experiences that inspire. Don't sacrifice one for the other. Choose a payments provider who can deliver on both. Choose Marqeta. Learn more at marqeta.com/FTT. Hello, and welcome back to the Fintech Takes podcast. My name is Alex Johnson, and I have a slightly different episode for you today. Listeners to this show might remember a while back, I did a little experiment where I picked up an old essay that I had wrote. This one was about the history and culture of the CFPB, and I read it. And that was pretty much the whole episode. Feels weird to do, I'll be totally honest with you. Feels a little, I don't know, maybe self-indulgent, but I got good feedback on it because I know that a lot of the things I write sort of fly by before you can get a chance to read them. A lot of what I write is very long. I really do apologize for that. But I also think it's important. And I'm using these, let's call them Fintech Takes audiobook podcast episodes to resurface some of the things that I've written on topics that I think are really important and to resurface writing or research that I've done that I'm really proud of. Again, the first one of these that we did that you can go back and find in the feed is on the history and culture of the Consumer Financial Protection Bureau, which was and continues to be a very important topic. Today's audiobook episode is focused on gambling. Again, if you've been reading my work, if you've seen me speak, if you listen to the podcast, you know my new obsession is gambling and the rise of speculative behavior in financial services driven by companies like Robinhood and Coinbase and Kalshi and Polymarket and DraftKings and FanDuel. I think these companies represent not only a significant threat to the financial health and well-being of consumers, but also a very direct, as you're going to hear, competitive threat to banks, credit unions, and mainstream B2C fintech companies. These companies are not content to simply enable a little gambling on the side. They are trying to subvert the entire financial lives of American consumers. And in so doing, they are going to have a significant disruptive effect on the profitability and business models of banks, credit unions, and fintech companies. So the plan for today is to share my audio recitations of a couple of essays that I have written over the last 9 to 10 months, and then to end the podcast with a little bit of sort of additional commentary where I'll try to leave things on a slightly more optimistic ending note, because at points it may get a little dark as we go. Just fair warning. This is a subject that does touch on some areas that are at times dark, but important to look in the face and to take seriously. So we're going to start with an essay that I published back on March 7th of this year. It was the first kind of essay that I had really dug into the threat posed by gambling. And that essay is called "The Biggest Threat to Consumers' Financial Health." This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. The biggest threat to consumers' financial health isn't overdraft fees or credit card late fees or banks paying below market rates on savings accounts. It's gambling. The resurgence of gambling in our culture has already had devastating consequences on the lives and balance sheets of American consumers and their families. Now, there are plenty of statistics that demonstrate the truth of this statement, but I'll settle for 3. 1, the legalization of sports betting, which was unlocked by a 2018 Supreme Court decision, reduced net investments in products like savings accounts or mutual funds by bettors by nearly 14%. And every dollar spent on sports betting reduces net investment by $2.13. Every dollar spent on sports betting reduces net investment by $2.13. This effect is obviously more significant for financially constrained households. Number 2, there have been cumulatively 23% more Google searches nationally than expected for topics related to gambling addiction, such as gambling addiction hotline or am I a gambling addict, than expected since the Supreme Court ruling. Those search rates are, as you might guess, significantly higher in states that have legalized sports betting. Number 3, when sports gambling is legalized, the effect of NFL home team upset losses on intimate partner violence increases by around 10 percentage points. And those effects are more pronounced, again, in states where mobile sports betting is legalized. Now, these stats are obviously concerning on a societal level, particularly that last one. But they also matter more specifically to those of us working in financial services for 2 reasons. Number 1, when gambling subverts individual and household balance sheets, it negatively impacts the business opportunities available to banks and fintech companies. When a consumer spends more money on same game parlays, they have less money available to save, invest, or use to pay their bills. Number 2, the line between financial products and gambling products is being increasingly blurred. And as a result, the temptation for banks and B2C fintech companies to get into gambling is growing. The first point, I hope, is fairly obvious and doesn't require a lot of additional explanation. The second point is worth elaborating on. So let's do that. The last quarter of 2024, which happened to coincide with the election of President Trump, was a really, really outstandingly good quarter for Robinhood. Specifically, Q4 of 2024. Now, what changed in Q4 of 2024? Well, crypto. For the last couple of quarters, crypto prices and trading volumes have been surging wildly. And this activity level, along with the promise of looser regulatory environment, which we've been seeing so far, has motivated certain financial services executives to be far more candid about their visions for the future. First up, we have Robinhood, which, in its own words, was built to be a new kind of financial services company, one aimed at helping everyone build toward their financial goals. Now, in pursuit of this vision, the company has partnered with prediction market Kalshi to offer the ability for its customers to bet on the outcome of the US presidential election, a bet that attracted roughly $500 million in 1 week, and more recently, on sports. Then we have Coinbase. Much like Robinhood, Coinbase claims a mission rooted in financial empowerment, and like Robinhood, reported outrageously good numbers in Q4 of 2024 and moving forward. Now, like Tenev, Coinbase CEO Brian Armstrong has been pushing to open access to new asset classes for retail investors. Over the last couple of months, Armstrong has argued for a more permissive approach to listing meme coins. He has argued for utilizing distributed ledger technology to tokenize securities of public and private companies and make them available fractionally 24/7 to non-accredited investors. And perhaps most infamously, he's argued for deleting the CFPB, which is something that's largely been happening thanks to Russ Vogt. Now, everything that Tenev and Armstrong are pushing for, expanded access to sports betting and prediction markets, tokenized securities, loose, non-existent crypto regulation, gutting consumer protection regulation, seems feasible over the next few years, as the President Trump's administration's actions to date suggest. In fact, I would guess that many of the issues will be decided inside the White House over the next couple of months. For Robinhood and Coinbase, this is smart business. Despite some efforts at diversification over the last couple of years, both companies still make a majority of their revenue transactionally, which means that they are incentivized to keep their customers as active, buying, selling, trading, on their platforms as possible. And the best way to do that is to give customers a wide range of fun things to bet on. Thus, the utility of meme coins and sports betting to Coinbase and Robinhood isn't the expected value of the bets placed on those assets by their customers, which is overwhelmingly negative. It's the ability to keep customers engaged with their platforms, whether they're winning or not. This business model, which I've previously called speculation as a service, isn't common in today's mainstream consumer financial services ecosystem. For the most part, banks and B2C fintech companies make money through the combination of deposit storage and lending, i.e. net interest margin, and transaction fees for facilitating payments, debit and credit card interchange most prominently. However, what concerns me is that the success of Robinhood and Coinbase and the permission structure that will be created by the Trump administration's regulatory priorities will tempt banks and B2C fintech companies to experiment with speculation as a service as a business model. Now, my concern here is not hypothetical. It started happening the last time that Robinhood and Coinbase were booming. Companies like Drive Wealth and NYDIG spun up the infrastructure to enable banks and B2C fintech companies to offer fractional stock investing and cryptocurrency investing to their end customers. We started seeing a lot of announcements from mainstream B2C fintech companies and banks enabling that. Square launched stock trading in its Cash App. FIS teamed up with NYDIG to offer Bitcoin investing services through banks. Before this trend could deeply take root, however, the Fed raised interest rates, the bottom fell out of the crypto market, and regulators started cautioning banks to be careful with anything new or novel. However, it's easy to imagine an alternate universe where those things didn't happen in 2022, and banks and fintech companies' embrace of speculation as a service continued chugging along full steam. What would the market look like today if that alternative universe had been the one that we were living in? Would community banks have leveraged FIS and NYDIG to offer meme coin investing to all their customers? Would Cash App have added integrated sports betting? Maybe, or maybe not. But if the recent regulatory and legislative success of the gambling industry and the Trump administration's actions over the last year or so have been any indication, I fear that we will find out for ourselves over the next 3 years exactly what that alternate universe looks like. So, with that grim prognostication in mind, allow me to end this essay by offering 2 pieces of additional advice for banks, B2C fintech companies, and financial services policymakers. Number 1, start measuring customers' financial health. The most sustainably successful businesses are those that align their long-term interests with the long-term interests of their customers. In financial services, we know what outcomes consumers aim for in the long run: financial stability, economic freedom, and ultimately, the opportunity to build wealth for themselves and their loved ones. What's strange in financial services is that we don't really have any common metrics that we can use to measure consumers' progress towards those outcomes. This matters because it makes it difficult for incumbent banks and B2C fintech companies to objectively evaluate the potential of new fintech innovations and decide if and how they should offer them to their customers. Crypto is a great example. If you were setting your product roadmap based solely on what your fastest growing competitors are doing, you might conclude that you need to go all in, depending on what year it is, on NFTs or meme coins. If you are setting your roadmap based entirely on what your regulators or bank partners are fully comfortable with at any moment, you'd likely conclude that you need to stay as far away from crypto as possible. However, if you are objectively looking at crypto solely through the lens of what is best for the long-term financial health of your customers, and if you can run small-scale experiments with different crypto products and measure the impact of those experiments on your customers' financial health, you might come to a more nuanced conclusion. Something like, we should only offer Bitcoin investing, and we should strongly encourage our customers to adopt a long-term investment strategy like dollar cost averaging. To develop an objective view of consumers' financial health, the industry needs to develop a set of common metrics that we can use to measure consumers' financial health and the impact of different products on it. This is a point that former acting comptroller of the currency, Michael Hsu, repeatedly made during his tenure leading the OCC. Here's one quote. Much of the banking system continues to be organized by product and service lines or by geographies. The profitability and risk of those things are measurable, and we know that historically what gets measured gets done. I believe we can do better and truly put consumers front and center by measuring their financial health and supporting their efforts to improve it. Imagine if there were clear and objective measures of consumers' financial health. Hsu went on to use the term vital signs to describe these measures, and he proposed, based on research done by the OCC, that they focus on 3 specific areas. Number 1, positive cash flow. Allow consumers to meet their week-to-week financial obligations while also, ideally, setting some money aside for savings and investment. Number 2, liquidity buffers. The balance of liquid accounts and credit available is sufficient for consumers to withstand unexpected expenses or drops in income. And number 3, on-time payments. Being current on debts indicates that consumers can regularly meet their financial obligations and avoid delinquency and over-indebtedness. Credit scores do a decent job of measuring consumers' ability to regularly make on-time payments, but we don't have industry standard metrics for measuring positive cash flow and liquidity buffers. The good news is that the data necessary to measure those areas has become much more available thanks to the rise of consumer permission data sharing. However, there is still a lot of work to be done to build standardized financial health scores and monitoring services on top of that data. Banks, B2C fintech companies, and regulators should continue to engage in that work over the next 4 years. When it comes to your payments provider, you can't afford to compromise. Marqeta's modern payment solutions flex with your business without the trade-offs. Stable and agile, secure and innovative, scalable and configurable. If they say you can't have it all, don't believe them. Your business demands more. Choose a payments provider that delivers more. Choose Marqeta. Visit marqeta.com/FTT to learn more. Number 2, second suggestion for banks and B2C fintech companies is to make saving money more fun. It's very important for those of us who care deeply about the field of financial health to acknowledge a simple truth. Financially unhealthy behavior is popular because it's fun. You can scoff at that if you want, but the fact of the matter is that gambling and impulse shopping are really fun, and financial products that enable those activities will naturally be easier to sell than financial products that don't. If we can accept that fact, then it poses a critical follow-up question. Can financial products that enable financially healthy behaviors like savings be more fun? I think they can. Now, they'll never be as fun as gambling and impulse shopping. Instant gratification and sensation seeking, the tendency to pursue intense, risky experiences, are powerful motivators of human behavior, and they're not naturally compatible with financially healthy decision making. However, I do think there's an opportunity through better and more intentional product design to close a substantial portion of the fun gap between financially healthy products and experiences and financially unhealthy ones. And again, this isn't me theorizing. There are proven examples of fun, financially healthy products in the market today. The first one I want to mention is Digit. Now, longtime readers will know that I was a big fan of Digit, the fintech app that would automatically squirrel away small amounts of money from your checking account into a separate savings account based on continual analysis of your cash flow patterns. One of the things I loved about it in its early days before it was acquired was that the text-based user interface would inundate you with these encouraging updates about your progress and affirming gifts about how awesome you are. It really was delightful to use. And it might seem like a small thing, but this stuff matters. It's the same reason why Robinhood used to celebrate customers' trades with virtual confetti. Fun user experience quirks matter. They shift consumer behavior. The second example I want to discuss is Save Now, Buy Later, also known as SNBL. SNBL is the Bizarro version of BNPL. It provides the same embedded payment capability within key points in the shopping journey in e-commerce websites and apps. The difference is that while BNPL is designed to facilitate instant gratification through credit, SNBL is built to encourage delayed gratification through savings. A customer finds something they want to buy online. The merchant presents them with the option to save money in order to make that purchase at a later date. The consumer selects from a number of different options for how to save up the money: set and forget, one-time deposit, payment roundups, crowdfunding, etc., and starts saving. The merchant may chip in rewards to help accelerate the customer's progress. Rewards can only be redeemed as a purchase. And once the customer reaches their goal, they are notified and directed to the merchant to complete the purchase. It's essentially like if Amazon Wishlist had an embedded savings account. And according to Accrue, who was an early pioneer of SNBL in the US, it works. It encourages shopping, which is fun, without requiring impulse spending, which is responsible. The last example I want to throw out there is prize-linked savings, or PLSAs. PLSAs are savings accounts that pay little to no interest to individual depositors, but instead pool that interest into larger prizes that depositors can win in periodic lotteries. They are designed to encourage savings by giving customers who deposit more money better lottery odds. In other words, every $50 saved equals another lottery ticket. This approach is irrationally appealing to people in the same way that gambling is. Humans often prefer the chance of winning big to the certainty of winning small, but it removes any possibility of the consumer losing money. You're not risking your deposit, just some of the interest you could have earned on it. There hasn't been a ton of research done into PLSAs, but the research that we do have suggests that they work extremely well. Additionally, the anecdotal evidence from bank and non-bank providers that have offered PLSAs, which still aren't super common in the US, support that same conclusion. Walmart, in partnership with Green Dot and Commonwealth, launched a national prize-linked savings program through its prepaid card in 2017. Which resulted in customers increasing their savings by 35% on average, and collectively more than $2 billion being saved by Walmart customers in just 2 years. Truist ran a pilot with Commonwealth in 2021 to offer prize-linked savings to its customers. In just 6 months, the bank saw more than 25,000 households sign up, resulting in $37 million in new savings. The following year, Truist acquired Long Game, a fintech company specializing in prize-linked savings and other gamified financial health strategies. Perhaps my favorite recent example is Layup, a prize-linked savings app that uses sports betting via the randomized assignment of picks on daily games with 50-50 betting lines to determine the outcome of its lotteries in an attempt to entice sports bettors into a more financially healthy alternative. All of these examples, more fun UIs for savings products, SNBL, and PLSAs, deserve significantly more experimentation and investment from banks and B2C fintech companies and their VCs. And regulators and policymakers should do everything possible to encourage this experimentation and investment. I want to end by saying that eventually there will be a large-scale societal backlash against gambling in this country. I don't know exactly when that will happen or what it will look like, but it will happen. Consumers can only get hurt like this for so long before something breaks. And when the pendulum swings back, the banks and B2C fintech companies that facilitated consumer harm will get crushed by it. Robinhood and Coinbase may not care about that, but everyone else should. Long-term, financial health is a better business to be in than gambling. Okay, that was the biggest threat to consumers' financial health. I hope you enjoyed it. As you probably heard throughout, there were a couple points where the data is a little out of date because this, again, was written in March of this year. Sadly, I'd like to say that after I wrote that, everything became okay and we stopped pushing the boundaries forward on speculation. I cannot tell you that. I know you know that that's not true. Everything just got worse after March 7th. And Robinhood, Coinbase, and a number of other companies who I'm going to mention in the second essay just kept pushing forward and pushing the boundaries in ways that, quite frankly, as an observer of the market, I found deeply disturbing. And so the second essay that I'm about to give you a recitation of is about what happened in the aftermath of that. And specifically, it addresses some of the feedback that I got after publishing that first essay. This second one was published in August. It was on August 29th. So fast forward a few months. I wanted to kind of recap what had changed and also respond in pretty loud language. So you're going to hear that on this recitation. It was fun to do it. How I feel about the response that banks and credit unions and fintech companies had to my concern about the rise of gambling and its impact on financial health. So this second shorter essay, which is really, I think, in some ways classified more accurately as a rant, is called "The War That Banks Don't Know That They're Fighting." In the essay that you just heard, I wrote about what I believe is the single biggest threat to consumers' financial health: gambling. In that piece, I explained how certain companies are blurring the lines between investing and gambling, and why confusing those two concepts is extremely dangerous for consumers, especially young consumers. Now, what's interesting is the feedback that I got on that essay was mostly positive. Bankers, which for the purposes of this essay, I'll define as those who work at banks, credit unions, or mainstream neobanks, generally agreed with the central thesis: excessive speculation in financial services has the potential to wreck consumers' financial lives. However, their agreement felt more philosophical than it did tangible. It felt the same way it does when two old people complain about kids these days. A lot of tisk tisk, but no real desire or intention to actually take action or change any results. Bankers may not like the rapid growth of sports betting, meme coins, and prediction markets, but they also don't seem to view it as their problem. The way I know this is that when I ask them what they're planning to do about this surge in speculative investing, they mostly just shrug their shoulders. And when I suggest potential solutions, a predictive model built on cash flow data that can identify early signs of problematic gambling, or a tool that automatically and instantly transfers a large portion of consumers' gambling winnings to a savings account or mutual fund, they get this slightly horrified look on their faces, and they reply in a low voice, "It's the customer's money. It's none of our business what they choose to do with it." Okay, let me pause for a second, take a deep breath, and state this next part as calmly as I can. It is your business. You are in the business of helping your consumers store, transfer, borrow, and grow their money. It is literally your fucking business. Whenever I discuss financial health and bankers, this is what drives me crazy. I'm not asking you to care about this out of a sense of altruism or some misguided paternalism. Focusing on improving your customers' financial health isn't altruism or paternalism, it's capitalism. Cold, ruthless, selfish capitalism. Bankers are in a war that they aren't even aware of. And the enemies in that war aren't hard to identify. We can name them. They are Robinhood, Coinbase, Kalshi, Polymarket, FanDuel, and DraftKings. These companies are siphoning away your deposits and investment dollars. One study found that every dollar spent on sports betting reduces net investment by $2.13. We just talked about that. They are driving your customers deeper into credit card debt and causing them to overdraw their checking accounts more frequently. They are reducing your customers' ability to make on-time payments on the loans that you have given them, and they are causing your ACH dispute rates to spike. Buyer's remorse on bad bets is a well-known cause of friendly fraud in the pay-by-bank world. And you know what? These companies aren't content to simply be an outlet where your customers choose to spend their money. These companies want to capture your customers' paychecks. They want to create closed-loop ecosystems that keep as much of your customers' money trapped as possible. They even want, in some cases, to compete directly with you to offer financial products and services, banking, payments, lending, to your customers. And again, I feel like I keep saying this. This isn't me speculating on what might happen in the future. This is happening right now. Robinhood offers a debit card that supports direct deposit, 2-day early paycheck access, and automated investing when customers get paid. It offers 4% APY on uninvested cash in customers' brokerage accounts. It offers a premium credit card and has announced plans to introduce checking and savings accounts as well. Coinbase similarly offers direct deposit, including converting some or all of your paycheck into crypto, a debit card, a premium credit card, and the ability to earn up to 4.5% yield on USDC balances, or potentially even higher now if a customer agrees to stake those balances for use in DeFi lending pools. Kalshi, unbelievably, pays 4% APY on all money kept in the platform, both in users' accounts and in their open betting positions. Polymarket conducts all of its transactions in USDC and allows customers to easily fund their crypto wallet with USDC from bank accounts and debit cards and credit cards via MoonPay. Robinhood and Coinbase, as I already mentioned, both lend against on-platform assets that their customers own, stocks and crypto respectively. This margin lending is even starting to appear in the prediction market space. For example, there's a company called Gondor that will allow Polymarket customers to borrow against their open positions. FanDuel and DraftKings both support Play Plus, which is a stored value account with FDIC pass-through insurance that links customers' sportsbook wallets to Discover branded prepaid cards that they can use anywhere where Discover is accepted, as well as at ATMs. These companies all understand that in a digital economy, attention and money are inextricably linked. They have built incredibly fun and addictive games designed to capture and hold consumers' attention. And the money is beginning to follow that attention. Again, I'll try to say this calmly, but I won't be able to. Banks need to wake the fuck up and pay attention before that trickle of money becomes a flood. Okay, those are the two essays back to back. It was cathartic to read them. It was cathartic to, at a certain point, yell into the microphone. Sometimes I feel a little bit on this subject like I'm yelling into the void. But I will say, to end on a slightly more optimistic note, since I wrote that second piece, I have actually gotten a ton of engagement from various folks in the ecosystem, folks in the open banking space, folks in the neobanking space, folks from traditional banks and credit unions, even folks who work in sort of the broader sports betting and gambling industry who see this problem coming, right? Again, I want to emphasize, I don't have a problem with sports betting or with gambling. My My personal political feelings are that we probably shouldn't legalize it. That's not up to me. But I do think that we can all get aligned on the idea that there's a version of this that is just entertainment, right? It's the same as your Netflix bill. It's the same as any other expense. It's the same as going out to eat. People can apportion those expenses however they want. And I think it is paternalism to dig too deeply into that. And really, our job as financial services providers is just to enable the choices that our customers are making. If it's at that level, I think it's fine. What I want people to understand and appreciate, and what I think they are starting to understand and appreciate based on the feedback I've been getting more recently, is that this is not what's happening right now. All of these apps, and again, we have prediction markets, we have sports betting apps, we have commodities futures markets that are more traditional. And then, of course, we have the sort of crypto and investing apps, most prominently represented by Robinhood and Coinbase. All of these companies are in a frantic, desperate, climb over each other, stop at nothing to win competition right now. And as a result, they are driving the state of US consumer speculation to a point that I don't know that we've seen before in modern American history. And what's going to happen as a result of that, as I said at the end of the first essay, is that there is going to be a backlash. And I think we need to be prepared for and, in fact, plan for what that backlash is going to look like and how banks and fintech companies that don't want to get into the business of speculation can support their customers. And again, I already mentioned some of these ideas, but it can be very simple things, right? How closely are you analyzing your customers' spending patterns? Do you have a sense, even just internally, of which ones may be getting into gambling addictions? Have you modeled what the impact of a gambling addiction by a customer might have on their ability to make their payments on the loans that you have with them? If you haven't, you should. And if you have, you should at least consider proactively reaching out to that customer. And again, you don't have to be paternalistic. You don't have to confront them. It doesn't have to be an intervention. You don't even have to mention why you're calling them. But you can just reach out to them and offer support. I think that proactive, caring, financial health-oriented approach to servicing, to customer service, is going to become really, really important over the next couple of years as we see just how much gambling is going to alter the lives of American consumers, particularly younger consumers, particularly younger male consumers who we know are getting hit the hardest by this. So I will say to end, I am slightly cheered by the response that I've seen from some responsible folks in the ecosystem. And I hope that we can really rally around this problem to fix it or to at least mitigate it before it gets even worse than it is right now. Thank you. And I hope you enjoyed this episode. Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.